ALIS, a practitioner's viewpoint. Why now? Oops, sorry. So first, for those that may not yet be familiar with what ALIS is, let me expound. ALIS is the confluence of 5 factors. The exponential growth of data is 1. Data science is 2. Machine learning finally working is 3. Low-cost on-demand cloud storage and processing power is 4. And the information edge is a risk is 5. These 5 factors have recently just coalesced to enable ALIS. This is a bit like what Rotem said a few minutes ago. So I'll touch on each of them briefly. 1, the exponential growth of data. So by show of hands, how many of you are aware that data is growing exponentially at Moore's law? So yeah, great, okay, pretty much everyone. 2, data science. It's a relatively new field, and all this unstructured non-financial data that's growing at Moore's law, as many or most or all of you know, needs to be normalized, classified, parsed, and organized. 3, machine learning was invented nearly 70 years ago, post-World War II, and now it's really working, and it's really working well, and beyond, I think, what anyone could have imagined. Obviously, there have been decades of overhype and resultant disappointment and disenchantment with machine learning. And there were various reasons for this, including insufficient data and expensive processing and storage. Just for example, I have a colleague in New York who was an HFT trader, and he said, yeah, I tried neural nets a few years ago. You know, you can only do 1 layer. They took days. It was clunky. Processing was expensive. And I said, you know, it's a different world now. So though as investors, we rarely, if ever, believe or say it's different this time, we do believe it's different this time. Look at the accomplishments by AlphaGo and GoZero in Go. I'm sure everyone in this room knows that. 2 decades ago, for example, a world-leading scientist thought it would be 100 years before a computer could beat the human world champion in Go. Well, Go has 10 to the 700 permutations, more atoms than there are in the universe. 2 decades later, from when that world-leading scientist at the Institute of Advanced Studies said it would be 100 years before a computer could beat humans, his name was Piet Hun, Dr. Piet Hun. In 6 years, with machine learning, AI, humans were eclipsed by man and woman plus machine, AlphaGo and GoZero. So later on in this symposium, oh, actually, sorry, we'll talk about that later. So anyway, we would argue moves like the one on the 37th move of AlphaGo versus Lee Sedol that had never been codified in thousands of years of human playing were the equivalent of creative, if not actually creative. Coincidentally, in chess, there was a pivotal move in Deep Blue versus Garry Kasparov on the 37th move. Move, M-O-V, in assembly language, as again, many of you in this room probably know, means replace the old with the new effectively. So we believe on the 37th move, the old paradigm of people beating machine was replaced by people plus machine beating people. That's why we call our company Move 37. The 4th point is low-cost on-demand cloud storage and processing power. For example, what cost $1 million to compute in 1980 costs 4 cents today, an exponential decline. This, along with data science and machine learning, are why we do believe it's different this time. 5th, the information edge is a risk. In a world where investors who seek to gain an information edge from companies are penalized with fines and prison, this lends itself to the use of anonymized public data for investing. So for context, if you look at this confluence of these 5 factors, we believe it's akin to Uber, or in Israel, I've been using Get everywhere to get around. So Uber or Get are a confluence of 3 factors, right? GPS, cellular Wi-Fi networks and phones, and the internet. If you didn't have any one of those, you couldn't have had Uber or Get, really, or the way we know them. And Uber was heavily disruptive to the taxi and limousine industry, to the point that New York City taxi medallions are down 80% from their peak value, from $1 million to 200,000. So we believe ALIS will be similarly disruptive to investment management. So that's just a brief prelude on what it is. So what have we done over the last 2 or 3 years about this? Well, we've traversed the globe searching for the best ALIS managers. We've been through Asia, Europe, Americas, the Middle East, and researching these managers. We've met with over 200 funds. And if you look, for example, at an industry database like Eureka Hedge, I don't know, they only know 30 or 40. And I think we know more than anyone in the world, quite frankly. And I'm not saying that from a conceited perspective or anything. I just think we have this unilateral focus on it, whereas I'm not aware of any other, or very few, if any, other firms that do. And if you look at these funds, a very small number are running in the hundreds of millions of dollars, and the vast majority are running sub 100 million, even sub 1 million, 5 million, 10, 20 million dollars. That's Christopher Columbus's route on the map, by the way. Slide 3. So when costs plummet, investors gain. ALIS managers are not what we refer to as alpha hogs. So they don't feel a divine right to charge fees at the rate of 2 and 20 or far more. In fact, some are at 1 and 10, and many others are at this 1, 10, 20 fee structure that we invented effectively. We wrote a paper on this, which was published by Pensions and Investments. You can find it on the internet if you like. And we based it on the Nobel Prize winner concept of alignment of interests. And so just to very briefly explain, 1, 10, 20 or 1 in 10 fees at net returns below 10%. So that's a 1% management fee and a 10% incentive fee. And 1 in 20 fees at net returns on all assets above, provided the investor achieves a net return above 10%. So we think this is an ideal alignment of incentives. And basically, what it does is at lower rates of return, it lets the investor keep more of the profit, and at higher rates of return, the manager gets a higher percentage. There's effectively a catch-up. That's what the kink in the purple curve on the top is. And we think that's fair at very high rates of return from managers that are delivering pure alpha with no beta. We think this is a very fair fee structure. This contrasts with, like, I can think of a top quant fund that I would think everyone in this room knows, based in New York with 1,000 employees or more. And for example, their flagship fund was up 15% last year, gross of fees. The fees were 3 and 30. Net of 3 and 30, you get down to about 7, 8%. So the manager kept half of the return. And if it were a 30% gross return and the investor were left with 15, maybe that actually would be okay because with no beta, all alpha. But from a 15 to a 7, and then particularly if you're in the U.S. and you're a taxable account, we would say that's being an alpha hog and that the manager is taking too high a percentage of the fees from the investors. And I'll leave 5 or 10 minutes for Q&A. Which ALIS managers are better, which ones to avoid? So that's Maynard Keynes' beauty contest up there for those of you that are familiar with that. So we're going to talk about what we call 5 genres of ALIS managers, including the best and worst attributes of each. So genre 1, acronym soup. So obviously we made these up. The best ALIS managers optimize machine learning techniques and focus on depth rather than superficial coverage. They understand exactly why they use a particular machine learning technique. They don't just use off-the-shelf code. They custom tailor it to exactly suit their needs. The worst ALIS managers fall into acronym soup. They basically, in our experience, what they're doing effectively is overcompensating for a lack of substance by asserting that they use every acronym of machine learning. So a typical due diligence meeting might go something like this. We'd say, what type of machine learning techniques do you use? And the alphabet soup manager would say, we use SVM, PCA, NN, NLP, and KNN. Right, exactly. And obviously referring to support vector machines, principal component analysis, neural nets, natural language processing, and K-nearest neighbor. There are some ALIS managers who do employ many of these techniques together, but in our experience, there's only one that I can think of that really does it well using multiple of these techniques. The rest of them really have one dominant machine learning strategy. Yeah, so we would say there's typically an inverse correlation between the number of ALIS techniques employed and the quality of the machine learning and the fund. So let's move on to the next point. Genre 2, to PhD or not PhD. So I think there are probably a lot, if not most, PhDs in this room. In our experience, the best ALIS managers are highly educated. I'm a big Shakespeare fan, that's why we joke to PhD or not to PhD, as in to be or not to be. So one of our fundamental premises of investing in ALIS managers is that to be a successful ALIS manager, you only need 1 or 2 PhDs. It's not like the large quant funds like the D. Shaws, the Rentecs, the 2 Sigmas, where they have hundreds or possibly more of PhDs, 100 or more of PhDs. We think that the playing field has been leveled. We believe ALIS leverages the strength of man plus machine or woman plus machine. And generally, in our experience, the top ALIS managers have PhDs from the world's best schools, though not necessarily Ivy League, but often technical, including schools in Israel. The degrees, in fact, may be in statistics, particle physics, epidemiology, machine learning, visualization, robotics, just to name a few. For example, we have identified one ALIS manager who we think is world-class and has proven himself in terms of returns and Sharpe ratios over multiple years. He's exceptional. He went to a top school. He studied computer science. He was a gamer hacker at an early age. He effectively is an autodidact. He educated himself in many of the machine learning techniques and technical trading of the market. But the rest of the top decile ALIS managers that we've met with in the world, of the 200, generally have 1 or 2 PhDs from top schools, technical or otherwise. And the worst typically have less education and experience. Like, for example, we did a meeting with one ALIS manager who was discussing his PhD, but then when we drilled down deeply, it turned out he didn't have a PhD. It was from some mediocre state school in the US, and he never finished it. And it fit with like what he was pitching us in machine learning. It was alphabet soup, and it wasn't very good. So a PhD, though, is not enough. There are plenty of ALIS managers who have PhDs, but they don't understand investing. And that's a problem, too. That's an automatic pass. When I worked at one of the world's top hedge funds, one of my partners used to joke, if I could short that fund, I would. And we often say that with ALIS managers. Right. So for example, we met an impressive ALIS PhD with strong machine learning, and he's a professor at a top school in the Midwest in the US. However, there were 2 primary and irreconcilable problems with the fund. The first was the fund was naked short options, and not surprisingly, in February, that didn't work too well this past year, right? And that's just a strategy that I learned early in my career to not invest in because of the left tail risk. And the second issue was the prime brokers had convinced the manager to turn liquid large cap securities into illiquid swaps. So we joke it's revenge of the MBAs. In any case, exactly, it's an example where the man in the man plus machine formula, or woman in woman plus machine, we do have one ALIS manager that we're invested with who is a woman PhD, and she's fabulous. In any case, the man or woman must be a strong investor and understand markets and investing. Just having a PhD from a top school is not enough. And then another example is sometimes there may be plenty of PhDs, years of research, and inordinate amounts of money invested, but nothing to show for it. Because Silicon Valley has revolutionized and disrupted many industries, ranging from the taxi business, which we discussed earlier, to advertising, there's often a view that Wall Street or investing is no different. That's absolutely not the case. I was discussing this just this morning with a top computer visualization professor in Haifa at Technion this morning. For example, we've also seen ALIS managers in the unsecured lending space and without PhDs. So apropos Andre Lieberman's talk a few minutes ago before me, and they came up with models that were effectively short a put and worse, levered them only to lose large amounts when the loans stop performing. More troubling are managers in the peer-to-peer space, again, using machine learning or ALIS, where they have no credit, distressed, or workout experience. Once they buy these loans, there's no secondary market. They own them. So we believe that these managers are likely to lose large amounts of principal in the next economic downturn. And that was like a question that was asked in the top left quadrant of the room about, are the models for the peer-to-peer trained to account for markets like 07, 08? Some of them may be, but certainly I've met with some that are not. Whereas that contrasts with the best ALIS managers, where they do incorporate tail risk-like markets in their algorithms by either disproportionately weighting them or through other techniques. But the best ALIS managers do account for that, or in our view, run market neutral or no bias or variable bias or low bias so that it's not a beta bet. So even though the managers are trained on maybe trained on what includes a 9-year bull market, they're not contingent upon equity beta or markets going up to do well. So genre 3, backtest heaven. So the best know that history doesn't always repeat itself. The top decile managers that we've identified all have actual tracks ranging from a year to a few years. The actual returns are impressive, not only in terms of level of return, but also due to the quality of returns. I mentioned this previously. They're low beta, high alpha, uncorrelated to indices, and are generated by idiosyncratic sources. The return streams are not predicated on easily and inexpensively replicable factors. So this is, in our view, the best ALIS managers are not factor investing, they're not smart beta, they are finding pure alpha, idiosyncratic, uncorrelated, like what the Citadels and Millenniums of the world try to do, more discretionarily typically. So with top ALIS managers, one's paying for alpha, not beta. That's why that fee schedule I discussed makes so much sense, we think. And they're small emerging managers, so they're amenable to those fees. So the worst ALIS managers live in backtest land, as we joke. They usually have phenomenal backtests, hypotheticals, or pro formas, but no actual returns. We call them heavenly theoretical returns because they were overfit. And when actual dollars are deployed, they become hellish. They go from heaven to hell. There would have to be quite an extraordinary circumstance for us to invest in an ALIS manager that doesn't have an actual track record. For example, Jim Simons might be an exception we'd make, but short of someone like Jim, we would never invest in a backtest hypothetical pro forma, particularly in ALIS, as hopefully or probably you all know. It lends itself to overfitting. And it's so funny, actually a fellow, someone who was one of my professors came to me, and it was funny, he showed me a back test, and then he showed me the actual track, and it was like precipitous decline. Let's see, and usually what happens is, the ALIS manager will come up with these back tests, and there are these insane returns, like 20, 30% per year, Sharpe ratios in the mid-single digits. And then at some point, they scrape up enough capital or intestinal fortitude to actually launch the fund. And then it's like I just described. Let's see. Yeah, and then, for example, there's another manager we met that had a track record, but the track record was long only, with no shorts. And again, that's something we would never invest in because the track is meaningless without shorts, without short borrow, slippage, transaction costs, availability, all of that. To us, that's just as worthless as a backtest or pro forma. So genre 4, the disreputable. Our friend Bernie Madoff's on there. The best ALIS managers have integrity, obviously. We vetted all of our ALIS managers. They are who they say they are. They do what they say they do. We sign NDAs. We get very good disclosure of their historic trades. We actually analyze their historic trades. We make sure that fits in with the way the manager says he or she is making money. The worst are disreputable. It's fortunately a tiny minority of the of the ALIS universe, but we have come across a few. And we haven't spent a lot of time to confirm or disaffirm their disreputable status, because all we know is they're bad enough to not warrant further due diligence. One manager asked us how much and how quickly we could invest. Our response was a highly respectable institutional amount within the next 6 to 12 months, which is a quite reasonable example for, I think, any investor, but certainly for an institutional investor. And the manager had only run a small amount of capital, like $1 million, at insane rates of return, supposedly. And they went on to tell us that and we suggested we'd invest 5 to 10 million, for example. And they went on to say the amount that we suggested may be insufficient for them to warrant expanding their limited time and resources on our due diligence process. They also went on to ask, could we not invest more quickly? Another manager told us they learned from some of the world's top investment managers, including one that I worked for. It turns out they never worked for that manager. Instead, they were a service provider who worked for the manager. And they said they learned by seeing my trades and our trades in positions. So picture someone working at Citgo, the administrator, and saying that by working for Citgo, they learned from Stevie Cohn or Paul Tudor Jones or George Soros. I don't think so. Right. So we once also set up a dial-in conference for ourselves and an ALIS manager in another country. And we asked them, do you have an office? And are you all there now? Because it wasn't clear that they did. And they said, yeah, we're there now. Well, we had the dial-in numbers, so we could see there wasn't one dial-in, but there were multiple. So even if they did have an office, they were calling in from different places. And I'm not even sure they did have an office. Another one who fit multiple of these genres, including acronym soup and backtest heaven, another one bragged about their system picking up on insider trading patterns. At least they're making it easy for the SEC to find them. So that was nice. Genre 5, legacy firms. So that's obviously a handsome cab. So the best ALIS managers, in our experience, are relatively young. They're not legacy firms. Legacy firms are inherently not ALIS. Legacy firms are large established firms that have often been around for a decade, sometimes even multiple decades. They typically have hundreds, and in some instances, over 1,000 employees. They may have their own in-house servers and storage, and often maintain multiple offices around the world. Again, Rotem mentioned this at the beginning, the fabulous availability of low-cost cloud computing and storage. We think that is part of this whole equation in terms of the ability to employ ALIS. So these legacy managers are typically systematic and rely on either academic finance, fundamental data and or old-fashioned technical models such as trend following and or mean reversion, linear regressions, and price volume data. They're often very large in AUM, like can be 5 billion assets, 10 billion, 100 billion. They don't typically use much, if any, alternative, unstructured, or non-financial data. ALIS managers do typically use alternative, unstructured, or non-financial data. And you can think of a lot of the large CTAs. So we're fine with CTAs. It's just what we don't like is when they pretend they're an ALIS manager and they're not. We think there's a nuance where the best CTAs may have their traditional legacy and then they have their ALIS, and they're just two different things. But what we've experienced with a lot of the large CTAs globally, in London, the US, particularly, for example, is that they say they're ALIS, but they're not. What it is it's typically like an old school CTA using some basic regressions and trend following. But because ALIS is a hot, machine learning and big data are hot marketing terms, they tell investors that they're doing it. So we have a team of MIT PhDs that works with us on analyzing these managers, and we'll go down there and they'll say, oh yeah, we'll meet with you, we'll talk about it. And when we drill down, again, we sign NDAs so we can, non-disclosure agreements. What we find is they're not really, they may have some random machine learning algorithm somewhere, and they may have some random alternative data source, but they're not really doing it. And again, I'm running out of time, but the whole thing is, it's like if you were building a fund today our contention is you wouldn't build it the way these firms built them 5, 10 years ago. You would build it completely differently with a couple of PhDs, cloud processing and storage, data science. And lastly, I know I'm sort of a bit over, just running out of time, but I'll just give a very quick summary. So we're saying ALIS is the synergy or intersection of the circles in the Venn diagram on this page. It's man or woman, the machine, the data science, the exponential growth of data, and the low-cost computing. We spent the last 2 years meeting with over 200 managers. It's been great. I've oversimplified a lot of this because we had to jam it in 20 minutes. But we've had a lot of fun, and we've found some great managers, and we do think ALIS will be highly disruptive to the investment management industry prospectively. Thank you.